Okay, hello everyone, I'm Edwin. So happy to see you again. So last week the stock market continued to drop and many people are talking about whether it's just a correction and stock price is going to go up again. But then other side think that maybe the stock price has already risen for a long time, it's going to enter to a bear market. A technical bear market can be defined in the case that overall stock market dropped by more than 20% from its highest. So did we already enter to a bear market? For those hottest stocks, the performance is actually quite bad. Tesla fell by 33% from its highest, ARKK fell by 26%, Tencent fell by 12%, and Meituan fell by 26%. But the situation is not that bad in the overall market. The Hang Seng Index fell by only 6.7% from its highest, the NASDAQ fell by 8.9%, and S&P500 index only fell by 2.7%. And we can see that the current market correction is due to the market revaluation on the hottest peak, and the performance in other sector is not that bad, so the overall market drop just slightly. And this example also sends us a message that investing in an entire market is always less risky than investing in some individual stock. So before I introduce some index fund for your consideration, I want to talk about the differences in analyzing between individual stock and index fund. When we analyzing individual stock, we focus mostly on the quality of the company, like examining their P/E ratio, growth potential, corporate governance, or development, and etc. But for index fund, we need to make three key decisions. First, for macro sense, which market should we invest? It could depend on the market's prospect and risk exposure. Second, which industry should we focus? The answer should be based on your view on the future development in different industries. And third, which index fund you want to pick. So the first ETF or the first index that I want to introduce to you is Warren Buffett's favorite, which is the S&P 500 index fund. S&P 500 includes 500 large multinational companies listed in US. The year-to-date return is 0.33%, 1 year return is 24%, and P/E ratio is only 30 times. So although a quarter weight goes to technology companies, but the risk exposure are still quite diversified. And you can see that healthcare, consumption, finance, and telecommunication all account for 11 to 13%. And since there are 500 stocks in this index, each stock will not weigh too much in the index, and it helps to reduce the impact on the single company. For except the top three, Apple, Microsoft, and Amazon, individual weights are all less than 2%. Since it covers more than 500 large companies, S&P 500 does do a pretty good job in diversification. So no wonder it is Buffett's most recommended index investment. So in Hong Kong market, you can invest 3140 Vanguard S&P 500 Index Fund ETF. The management fee is only 0.18%. In the US market, you can invest in VOO Vanguard 500 Index Fund ETF. The management fee is as low as 0.03%. But bear in mind that we have to pay dividend tax for investment of US listed security, so the actual dividend income can be lower than the stated value. The next recommendation is NASDAQ 100. So this index includes 100 large companies listed on the NASDAQ. Although the year-to-date return is -3%, the 1 year return is 43%, which is quite amazing. More than half of the weight of NASDAQ goes to technology stock, and consumer service account for 25%. Adding them together, the weight goes to 80%. On the bright side, technology companies generate more profit and have a high valuation during pandemic, so the NASDAQ return is far better than the S&P 500 index in last year. But on the other hand, the NASDAQ index is much riskier than S&P 500 index for three reasons. First, the average P/E ratio of the NASDAQ has reached 36 times, much higher than the 30 times of S&P 500. So if the growth rate is not as good as market expects, the stock price will drop significantly. So second, the weights of the top 3 companies ranging from 8 to 11%. Therefore, NASDAQ index is subject to significant firm-specific risk. Third, the earning for technology companies is highly volatile. Therefore, NASDAQ is only suitable for people who have more risk-taking and more optimistic about the technology stock. So in Hong Kong, you can invest 2834 iShare NASDAQ 100 ETF. The management fee is 0.28%. In US market, you can invest QQQ, invest QQQ Trust Series 1. The management fee is 0.2%. Some of you may ask, how about the Dow Jones Industrial Average Index? My answer is that I'm not that suggest investor to invest in Dow Jones. So Dow Jones created for more than 100 years, and the industrial distribution is much more evenly distributed than the S&P 500 index. But as a long-term investment, the Dow Jones index is not that recommended for several reasons. First, the index includes only 30 stocks, so the coverage is limited, and the diversification benefit is also limited. In contrast, S&P 500 index includes 500 companies. The coverage is much wider. But then, why do media usually use Dow Jones to describe the price movement in the US market? So maybe media use it for a long time, or maybe due to its large index value. For example, if the US stock market fell by 10%, media can report a drop down of 3,000 points in Dow Jones. But then in S&P index is used to report, the media can only report a drop of 400 points. And definitely, the previous one is more eye-catching. The second disadvantage of Dow Jones to be an index fund is that it's about the weight of its calculating the individual stock weighting. The weighting is not depends on the market capitalization of a company. Therefore, the higher value and greater influence of large companies cannot be reflected in Dow Jones. As a result, the tracking error of the performance of Dow Jones on the US stock market is greater than the S&P 500 index. Third, technology sector is expected to be a driver in next decade, but Dow Jones only gives 21% weighting on this sector. That is why you can see that there is not many tech companies in its top 10 holding. And then when standard deviation is used to measure risk, we find that Dow Jones and S&P 500 has similar volatility. But when we compare their 5 years performance, we can see that Dow Jones underperformed S&P by 34%. And in terms of 1 year return, Dow Jones is still underperformed by 6%. For people who are interested in investing in Hong Kong listed securities, there are also 2 good indexes for considerations. First is the most traditional one, Hang Seng Index. The index includes the 52 Hong Kong listed securities. The FHP ratio is lower than that of the S&P 500 index. Hang Seng Index focuses mostly on financial sector, accounting for 40%, including banks like HSBC, China Construction Bank, and Industrial and Commercial Bank. For insurance company, it includes like AIA and Ping An. The second focus is on technology sector, which account for 25%, including Tencent, Meituan, and Alibaba. So investors who are interested in investing in the Hang Seng Index can consider 2800 tracker fund. Management fee is only 0.1%. The last one I want to introduce today is Hang Seng Technology Index. The index is just started last year, also known as the Hong Kong NASDAQ Index. The index includes 30 large technology stocks listed in Hong Kong. Compared with the 36 times P ratio of NASDAQ, its 26 P ratio is much lower. Its 1 year return is 65%, which is quite amazing. Information technology stock contribute to 67% of the index, followed by 14% weight to healthcare. And the top 10 holding including ATMX, Alibaba, Tencent, Meituan, and Xiaomi. Their weighting ranging from 4 to 8%. So as single company has a relative high rating in the index, the risk of technology stock is always higher than in the Hang Seng Index. So the Hang Seng Technology Index is expected to be a riskier investment, and it may be suitable only for those who are risk-tolerant investors who are interested in technology stock. So interested investor can consider about 3067 iShare ETF. Its management fee is 0.25%. Warren Buffett has a famous quote: "Only when the tide goes out do you discover who's been swimming lately." Stock investment, just like other professions, whether you can an expert depending on your psychology, knowledge base, and also talent. If you can become an expert, of course, you can actively try to capture the opportunity to buy low, sell high, right? But it does not mean that if you are not good in investment, you should not invest. Investing in index fund provide you a mean to earn pretty good return without learning those financial jargons. I guess the current financial market adjustment provide an opportunity to you to examine whether active investment fit you. The question that you ask yourself is, did your trading improve your returns? In other words, comparing to buying index fund, did you make more money? The following table can be used for your references. The following shows the returns for 3 indices from different starting months till today. You can then do the math to calculate your overall returns within this period. So let's say, if an investor starts to invest in Hong Kong market in July, we can see that the corresponding return in Hang Seng Index is 15%. So if the investor finds that the total asset value in his stock account is 15% more than its beginning balance and deposit, it means that investor did do a good job in beat the market. And it's good news. It means that maybe the investor can still keep active trading. But if the return is less than 15% or even negative, it means that active trading does not help you. And it also means that your return is lower than a passive investment in the index fund. Then in this case, investor can consider to invest at least part of your money in index fund. Then investor can do annual review to compare their performance between active investment and passive investment. But finally, I would say that investor will find the most suitable way for their investment. So if instead investor investing in the US market, then you may want to use the S&P500 index as benchmark. If let's say you mostly focus on US listed technology stock, then maybe it's better for you to use NASDAQ as a references. Investment like a marathon. To be successful, people do not need to rush, and then you do not need to be affected by other speed. Follow your own pace, play safe, and allow your capital steady growth. Then people can soon to have enough to achieve your own financial goals. And I wish you all to figure out your own suitable investment style soon. Thank you so much. If you have other interest area about the stock market want me to talk about, feel free to comment below. I'm Edwin. Thanks for watching. See you next time. Bye.